2 decades ago, when you walked into a bank, most big investment decisions were made based on the intuition of experienced executives in suits, perhaps sketched out on an Excel spreadsheet after a glass of fine whiskey. The person managing your portfolio was human and followed market news, relying on a few trusted sources. Today, the situation is completely different. There is now an intelligence that executes millions of transactions in mere milliseconds, detects correlations that humans could never see, and most importantly, knows your next move and where you're going to invest your money before you do. This intelligence neither sleeps nor takes holidays. It is no longer hidden away in tech company basements. It's at the heart of the financial world. It decides whether to give you a loan, how much your insurance premium will be, and which stock is about to plummet. Is this good or bad? Are traditional bankers obsolete? When you think of finance, trading is probably the first thing that comes to mind. Artificial intelligence has completely changed the landscape of this field. Trading is no longer done at the speed of human clicking. It is now done at the speed of light in fiber optic cables. The most dazzling yet controversial application of this technology is high-frequency trading, HFT. AI processes market data in milliseconds, 1,000 times faster than the blink of an eye. What does it do? It seizes arbitrage opportunities. It detects the brief moment when a stock is priced at $10 on exchange A and $10.01 on exchange B. It buys and sells simultaneously to pocket the difference. Humans cannot do this, but AI can, executing millions of transactions in under a second to generate massive profits. For example, imagine a central bank is about to announce an interest rate decision. AI analyzes the keywords in the text the moment it's published, calculates the potential emotional impact on the market, and executes the trade. Before a human investor can comprehend what happened, HFT algorithms have already taken and closed their positions. Another power of AI is its ability to read not just numbers, but also emotions. We call this sentiment analysis. By scanning millions of tweets, news articles, and corporate reports published daily, AI captures not just the words but also the underlying sentiment. Is it positive, negative? For example, if the CEO of a major company uses slightly anxious language in a social media post about a new product, traditional analysts might not think much of it, but AI reads it as a potential signal that the stock price could drop and positions itself accordingly. Thus, AI trades based on the market's collective state of mind. While AI brings speed and profit to the financial world, its biggest benefit is in the area of security. Banks used to try to detect fraud using rigid rules such as, any account that makes a foreign transaction over $5,000 is suspicious. However, fraudsters knew these rules. Now AI learns the normal behavioral patterns of every customer. We call this behavioral biometrics. AI examines hundreds of data points, such as typing speed, mouse movements, transaction flow, and typical login locations. If an account that usually does business in New York suddenly makes 3 small transactions 10 seconds apart from Indonesia, this is not just a rule violation for the AI, it's a behavioral anomaly. The system immediately blocks the transaction and notifies the user. AI can even detect and prevent new, unknown types of fraud by recognizing them as deviations from the norm. Credit scoring and risk modeling have also been fundamentally transformed. Getting a loan used to depend on very limited criteria. Now, AI calculates your potential risk by combining hundreds of data points. It not only considers your credit history, but also factors such as the stability of your employment, the consistency of your education level, and even the economic data of the neighborhood you live in. This produces a more holistic risk profile. This results in fewer bad loans for the bank and, more importantly, allows honest but underserved populations who were previously excluded due to insufficient banking history to participate in the financial system. AI has changed the lives of Wall Street giants and individual users alike. Professional financial advice is no longer a luxury service. Robo-Advisors are AI algorithms that learn your risk tolerance and goals. They automatically create and rebalance the most suitable investment portfolio for you according to market changes, and all for a very low fee. This is the democratization of financial advice. Your mobile banking app does more than show account statements. AI analyzes your spending habits and offers personalized advice. You spent $200 more on coffee this month than last. You could save X% of this spending. When you need it most, it can instantly offer you a loan with the best interest rate. Furthermore, AI is putting an end to the long waits when you call bank branches. Advanced chatbots can handle not only simple commands but also complex transaction scenarios. Finance is a huge pile of paperwork and bureaucracy. AI is silently taking over back-office operations and fundamentally changing this situation. RPA, robotic process automation, and AI can automatically read thousands of contracts, invoices, and legal documents and enter the data into the relevant systems. Compared to human error, the error rate drops to almost zero. There are billions of dollars in efficiency gains to be had here. AI-based RegTech, regulatory technology solutions, have automated anti-money laundering, AML, and Know Your Customer, KYC processes. AI continuously scans thousands of legal texts and global sanction lists to ensure compliance. This prevents legal penalties and reduces the cost of manual compliance operations by up to 70%. Artificial intelligence has become the profit engine and the most robust safety valve of finance. Despite this optimistic outlook, AI's fundamental changes to the financial system raise serious questions and pose risks. For example, AI might refuse to give us a loan or suddenly drop the price of a stock. But why? The interaction of the hundreds of variables that AI uses to make decisions is difficult for the human brain to understand, especially in complex models like deep learning. This is called the black box problem. In the financial sector, the ability to explain why decisions were made is a legal necessity. AI is only as good as the data it's trained on. For example, if a bank has historically given fewer loans to a certain demographic, an AI algorithm trained on this biased data could perpetuate this inequality, even unintentionally. This is a serious ethical crisis. AI algorithms must undergo continuous ethical auditing to ensure that financial decisions are fair and impartial. So, will AI take the jobs of financial professionals? The answer is both yes and no. Routine tasks such as simple data entry and manual document verification are becoming obsolete, while new specialized roles such as AI ethicists, XAI developers, and data scientists are emerging. For financial professionals, AI literacy has become a necessity, not just an asset. Financiers of the future won't just know accounting, they'll also be able to run Python algorithms and interpret the results. As you can see, AI has transformed finance, turning it from a tool into an ecosystem. It enables faster transactions, more accurate risk predictions, lower costs, and more personalized services. However, in this age of speed and intelligence, it is the responsibility of those who design the systems, that is us, to ensure human values, ethics, transparency, and fairness. AI is a tool. We are still in control, and we decide where to go. So, are you excited or worried about this major change? If you're curious about how AI affects your finances, share your thoughts in the comments below. If you found this video helpful, please like it and subscribe to this channel. See you in our next deep dive. Goodbye.